Okay, let's get going now. This is a chapter where we'll actually brush up on some accounting. As a matter of fact, chapters 2 and 3 are usually covered in a course called Financial Accounting. And so if you've had one of those courses, this is going to be just a rehash. But if not, this is going to set us up for value creation and business. And basically, after chapter 3 is really when we start to talk about finance topics. But here, this is basically what we do in finance is we take numbers that are already recorded by accountants and the accounting process and use it to make judgments about the value of a company. So let's look at these financial statements that are going to be in an annual report of a company. So what we are doing here is in this chapter we're going to be talking about the income statement, right, which is a record of what went on throughout a given period of time, such as what happened throughout a year, right? How much did we sell? How much did it cost? The taxes we paid, etc. Then we'll look at balance sheet, and a balance sheet is a snapshot. So it doesn't, while the income statement has flow variables, balance sheet has stock variables. So it tells us where we stand at any given point in time. So usually we're going to be looking at quarterly or annual balance sheet, and an annual balance sheet tells us where we stand at the end of the year, right? And then the statement of cash flows, because all the accounting process that we use is called accrual accounting. And so sometimes we have sales that are, say, made on credit, right, and not on cash. The tax law allow us to deduct major expenses like investment in a factory. To tax laws allow us to deduct that over a period of time and then depreciate it. And but that depreciation is not the cash flow. The cash flow occurs when we buy that plant or factory, right? When we make that investment. So we parse that out in the statement of cash flows, and that tells us where cash went, and where it came from, because the company's value is based on its free cash flows, and we'll cover that concept soon enough in this chapter, right? And of course, then we'll look at what we use to measure the financial performance of the company, how taxes are computed. That has a change, as you're well aware, with the new tax law, but the principle remains the same. So we're going to be looking at this. And what I'm going to do for these two chapters 2 and 3, is that I will take you through these slides that are actually based on the mini case at the end of the chapter. So if you have a paper book in your hand, there's a mini case that's at the bottom of page 133. Right? If you're looking at an ebook on MindTap, then you just need to scroll at the bottom of the contents, and you'll find the mini case. You click on that, and it takes you there, right? And so before we get to the mini case itself, here's a picture that basically starts in chapter 1, and it tells us where we are going to be focusing on. We're going to be focusing on how these free cash flows are determined, right? And this whole big picture tells us how a company is valued, right? And company is valued as these free cash flows over future periods of time. So FCF1 is next year's free cash flow, FCF2 is the year after free cash flow, etc. And of course, the company doesn't really have an expiry date, or so theoretically we are looking into an infinite amount of cash flows in the future. Fortunately, those very distant cash flows don't really matter much anymore, because if you see, we are discounting them to their present values by dividing each of those cash flows with 1 plus a certain rate. It's called, this is WACC, stands for weighted average cost of capital, and we have a whole chapter on that later. But that's a kind of like an interest rate. It's a rate of discounting in this case. So we divide it by 1 plus that rate. Let's say it's 10%, then it'll be 1.1, 1 plus 0.1, raised to the power of, well, that's a large amount, right? That's the last one. But suppose it's 100 free cash flow 100 years later. We'll take the free cash flow and then divide by 1 plus weighted average cost of capital raised to the power of 100. So the denominator becomes really, really large, and that value in today's terms is then very, very small. So, but certainly over the next 10 or 20 years, the free cash flow projections will matter quite a bit in computing the value of the firm. And where does free cash flow comes from? Well, it's fairly simple, actually. It's all the sales in a year, right? Revenues that the company generated in the year. And of course, we're going to be looking at cash revenues, right? Minus operating costs, minus taxes that the company has to pay. And then if they made any investments in operating capital, such as working capital, or building a plant or a factory, etc. So then what's left over is called free cash flows, and this free cash flows actually belong to the investors in the company, right? From this, we're going to pay interest to bondholders. From this, we're going to pay dividends to stockholders, because they are the investors in the company, right? Now, of course, where does that weighted average cost of capital come from? And I've already mentioned we have a whole chapter on that, but it's going to be based on what we have to pay to raise funds. Interest rates when we borrow, right? Then the cost of equity is going to be based on how much people want to pay for the stock, and to buy the stock, and that's going to be based on the future prospects, given the firm's business risk, its people's market risk aversion, and the debt to equity mix that the firm carries in order to finance its operations, right? And you'll see how all of this ties in later chapters. But right now, let's look at the determinants of free cash flow. And so we'll start with looking at the income statement. Once again, this is from the mini case in your book, right? So go to the end of the chapter 2, and you'll find the mini case. Okay, so here we have some numbers given, and just to look at the structure of income statement, right? Income statement is structured such that we start with the amount of revenues the company generates by selling. So it's 2015, it's 3,432,000, right? And in 2016 is 5.834400, so 5,834,400, right? So you can see that sales actually grew for this company from 2015 to 2016, right? We are looking at the financial statements, end of the year statements of Computron Industries. That's the name of the company, Computron. Then we have cost of goods sold, right? Cost of goods sold usually are all the variable costs that are involved. So those would be well, things like costs of raw materials, etc. Right? Those are variable costs. Then we have other expenses, and other expenses are going to be mostly fixed costs. Then depreciation, and depreciation is basically a certain amount which is calculated based on table, and so we have different kinds of tables, such as the MACRS table for depreciation, that gives us a list of assets and how you can depreciate various amounts in different amounts. The simplest one is straight line, right? And straight line depreciation is you take the total amount of an investment, such as say you spend $100,000 on buying a machinery, which can be depreciated over 5 years. Then you take the 100,000 and divide it by 5, and you get 20,000 each year, and that becomes the depreciation for 5 years. And as you can see, we can deduct that depreciation to lower the profits, right? So we're deducting cost from sales. So it's sales minus cost of goods sold minus other expenses minus this depreciation amount gives us the operating profit. Well, the total operating cost is this cost of goods sold and other expenses and depreciation. All these three combined was 3.222 million, right? And that you subtract that from 3.432 million, which is the revenues, and you get EBIT. EBIT stands for earnings before interest and taxes. We also sometimes refer to it as operating profits, right? And for 2015, that's 209,100. Then we subtract interest expense, right? Interest is a financing cost, not operating cost. It's a we have to pay interest when we borrowed money to, say, buy that factory for which we have taken that depreciation. But that interest expense is a financing expense, so we keep it separate. So EBIT minus interest expense gives us pre-tax earnings. You can also call it EBT, earning before taxes, right? Then subtract taxes. In this case, it's 40% of this amount, 146,600, 58,640, and you know that the corporate tax rate is not 40%. It never really was 40%, but it was in the high 30s, and now even the highest tax bracket, I believe, will have a tax rate of 21%. Anyways, but all we'll have to do now is apply a different percent. But it's the same thing. You take the percent, 40% in this case, of pre-tax earnings, or also known as EBT, earnings before taxes, and we get net income, which is 87,960, right? So that's how the accounting, principles. In U.S. we followed the GAAP. It stands for Generally Accepted Accounting Principles, right? It's dictated by Financial Accounting Standards Board, or a FASB. But this is an acceptable way of showing your income statement, right? So we have numbers for 2015, we have numbers for 2016. Well, we can immediately see that the sales have grown quite a bit, right? But there are other things also we can notice. We see that it looks like the total operating costs are much higher. It actually exceeds the growth in sales, the cost. All right. We also see among costs, all the costs have increased. Cost of goods sold has gone up quite a bit. Depreciation has gone up quite a bit, which means that the company must have acquired new machinery or new factory or new plant, something, some new fixed asset, right? Um, and interest expense has gone up quite a bit. How would that have happened if the company had borrowed a lot more money? Um, and we already know that the company made some new investment. It looks like much of it came from borrowed funds, right? But what happens now for 2016 is that before taxes, we actually have a loss, right? We have a loss of $158,560. Well, that means that um, we won't pay taxes. But if we had paid taxes in the past, we can start to recover it. So the income, IRS rules will allow us to get a refund. And so basically, getting a refund of $63,424 just last year alone, $58,640 must have been paid, and the year before that we must have paid more in taxes, and now this year we can claim a refund because of operating losses, and we get a refund of $63,424. So net income is not negative $158,000; it's only negative $95,000, right? So that's the income statement, and you can see that all of these are telling us what happened throughout the year, right? We didn't make that sale of 5.834 million on the last day of the year, right? That happened throughout the year. So this is the sum total of sales that were made. Those are the sum total of cost of goods sold throughout the year. So, well, here's what we saw from the income statement. I already talked about this a little bit, right? Sales increased by over 2.5 million. Costs shot up more than sales. Net income was negative, so the firm received a tax refund since it paid taxes more than that amount during the past 2 years. All right, now let's look at the balance sheet. And the balance sheet is showing us where we stand at the end of the year, right? So we have in our bank accounts $9,000 in cash, right? And short-term investments are basically if we happen to buy some bonds, some treasury bonds, or because instead of if you have a lot of cash, cash doesn't earn you any interest, so you can put some of your extra cash in short-term investments. And that was 48,600 at the end of 2015. It actually went down to 20,000 in 2016. And we kind of had seen from the income statement that the company had made some investment, and perhaps some of the cash was used for that investment. Accounts receivables, that's accounts receivables AR. Accounts receivables is the credit sales, right? So so basically this is saying that this much of sale that was reported in the income statement was made on credit, and so it is an asset because we haven't collected that yet, but it is coming to us. It's an asset. Inventories, of course, inventories could be raw materials, it could be finished goods inventory, but we see that inventories have jumped up quite a bit. That's not usually a good sign because inventory also represents something in which money is tied up. So anyways, but all of these can be liquidated or will be liquidated and turned into cash soon enough, right? Within a few days, maybe accounts receivables, maybe within a month, because you're extending 30-day credit to your customers or something like that. Inventories, when you sell them, they'll get liquidated. Of course, cash is already liquid; it's already in cash. So, turning something into cash is liquidating it, right? And all of these actually are appearing in the order of duration. How long would it take to liquidate something, right? So usually takes longer to sell inventory than to collect on accounts receivables, etc. So the total current assets, these are called current assets because these are supposed to be liquidated by the end of the next year, right? Total current assets. So if there's some loans, right, those will appear as notes. Anyways, all of these are going to be liquidated within a year. So total current assets is 1124000. Gross fixed assets. Gross fixed assets is basically the amount that you had spent on buying fixed assets like machines, like buildings, right? And so they had spent prior to 2015 $491,000. 146,200 of that has been depreciated so far, right? So that's how much this is cumulative depreciation. This is depreciation accumulating over the years, right? The income statement had already told us that the depreciation for the year of 2015 was only 18,900, but this is how much depreciation has been taken over the years, right, in 2015 and prior to 2015 and added up. And then we get net fixed assets, right? So in the book, the company's fixed assets were 344,800, right? That's 344,800 is the book value of these fixed assets. Of course, the market value can be very different than book value, right? Book value is based on historical cost minus all the depreciation we've been taking. Well, the net fixed assets, the growth in net fixed assets from 344,800 to 939,790 between 2015 and 2016, that growth shows us that the company has spent a lot of money during the year of 2016 to buy new fixed assets. Right? We kind of had concluded that looking at the income statement and seeing that the depreciation amount had jumped quite a bit, right? And the interest amount had jumped quite a bit. So anyways, so we can see that net fixed assets has gone up quite a bit. Also, accounts receivables has gone up quite a bit. Inventories have gone up quite a bit, right? So the company is growing in size, and also that made the reserves of cash and short-term investment go down. And basically that's what we see in this slide, those conclusions we had drawn. But we were looking at the one side of the balance sheet, or this is called the assets side, right? And the balance sheet is called a balance sheet because it has two sides that balance each other. This total amount at the bottom should be balanced with the amount of debt and equity that the company has, right? How did it acquire these total assets of that much? Well, it used either borrowed funds or equity from owners or shareholders if it's a corporation, right? So we look at the other side, which is liabilities and equities, and they should total up to the same amount as the total of total assets, right? So total assets, if we look, 2015 is 1,468,800, right? And then we look at liabilities and equities side, total liabilities and equities is also 1,468,800. And once again, here too we have an ordering of these liabilities that are based on how soon they will get liquidated, right? So there's accounts payables. It's the other side of accounts receivables. Accounts receivables in the asset side, that came from when we sold on credit. Accounts payables here on the liability side, it comes from when we buy on credit. So it's this amount that we owe to our suppliers, right, at this point in time at the end of the year. Of course, we will pay it off. We'll pay this over the next month. Of course, we would have bought new supplies, and so there's always some amount remaining in the accounts payable account. But this 324,000 in 2016 is expected to be paid off very soon. Notes payable. Notes payable is basically, these are short-term loans, right? It could be something that will have to be paid off within a year, and it could, in the beginning, it could have been a 10-year loan we had obtained 9 years ago, and now only 1 year remains, and we'll have to pay it off. So it's debt, right? It's borrowed funds. Accruals are other things that we owe money on. So it may be electric bill that we haven't paid yet, right? Electric bill for December that we pay in January, but our fiscal year ends in December, so we put that under accruals. And anyway, so those are again bills that will be paid off soon. So total current liabilities for 2016 is 1.328960, right? That's 1,328,960. Then we have long-term debt of $1 million. Those are borrowed funds. As a matter of fact, you can see notes payable have gone up between 2015 and 2016. That's debt. Short-term debt. Then we have long-term debt. That went up from 323,432 to $1 million. So a lot of money was borrowed during this year. No new shares of stock were issued because the common stock in C is 460,000 and it remains 460,000. But retained earnings is the amount of net income from the income statement that we don't pay out to shareholders as dividends. But we keep some of that retained earnings and can accumulate it over time. And that's done to fund future investments. And you can see that a bunch of the retained earnings, about half from 203,768, retained earnings dropped to 97,632. So more than half of those retained earnings were used to finance this investment that we know must have occurred in 2016. Right? So you can see that total debt goes up, equity goes down, right, during the time. And that's because we had to borrow funds for the investment and then use some of the equity that was in the retained earnings account, right? So we used both mix of debt and equity to finance the new investment. And of course, then total liabilities and equities should match the total assets from the asset side of the balance sheet, right? So that's what we see from the liability side. Current liabilities increased. It looks like we used creditors and suppliers to finance part of that expansion. Long-term debt increased to help finance the expansion. Right? Company did not issue any stock, but retained earnings fell due to the year's negative net income dividend payment. Okay. So we may not have used any equity to finance that, but in an indirect way because the net income was negative due to all the interest we had to pay on debt. Okay, so now we're going to look at statement of cash flows, right? And the statement of cash flows tells us where this money comes and where it goes. So if we do this right, then we can start from the cash balance of year one, and once we add all the statements of cash flows, we have cash flows that come from operating activities, cash flows that come from financing of activities, right? And when we add all of those up, we are going to be able to see how we get from one year's cash balance in the balance sheet to the next year's, right? So let's go back to the balance sheet, the asset side, and you can see that the cash account goes from 9,000 to 7,282 between 2015 and 2016. And if we do the statement of cash flows correctly, then we will see where that difference comes from. Right. So let's look at operating activities. We can start with the net income, which kind of showed us what we had after, subtracting all the costs and taxes, etc., from the revenues, right, over the year. But it doesn't reflect cash flows, right? Why? Because as we had seen, there was an accounts receivables balance, which meant all the revenues had not been received. There was an accounts payables balance, which meant that all the costs have not been paid out. And of course, there's this depreciation, which actually is a non-cash flow item, right? So we start with our net income in 2016, which was actually, if you remember, that was negative, right? Negative 95,136. All right. Well, we had obtained that by using this depreciation, which was a non-cash flow item, right? So we're going to need to add that back. It didn't really represent a cash outflow in operations. It's an accounting process, the process that we are allowed to do to save some money on taxes during that year of 2016. Then we look at the difference in accounts receivables between 2015 and 2016. Right. So we go back to the balance sheet asset side, and accounts receivable was 632,160 and 351,200, right, in 2015. It went up. If it went up, we take that difference. What does this mean? Well, it means that there was that much more sales that were made for which we haven't received any money yet, right? So if we take that difference, we would need to subtract it because we haven't really received this money, right? Likewise, changes in inventory, right? Inventory, think about things that have been produced and haven't been sold, but you have paid for all the raw materials and labor and everything in it. So inventories went up, and we need to subtract that. Now, those were from the current liability side. If we go to these were from assets, our asset side. If we go to liabilities, then it works the other way. So if accounts payables went up, that means we kind of used our suppliers' money to finance our operating activities, because this is money we haven't paid, but we have received the goods already, right? So if accounts payables went up, that positive change will need to be added. Likewise, if accruals have gone up, that positive change will need to be added. If it had gone down, we would subtract that, right? So finally, we get to net cash provided by operations, or used. If it's negative, it's used. If it's positive, it's provided, right? But it turns out to be negative, right? So start with minus 95,136, add 116,960, subtract 280,960, subtract 572,160, add 178,400, add 148,960, and then you're left with 503,936, right? And that's the net cash. Because it's negative, it's the net cash that's used up by operations. Now, let's look at investing activities, right? Cash used to acquire fixed assets, right? And that is basically the change in net fixed assets, right? So we look at the balance. Once again, let's go back and look at the balance sheet. This time we look at fixed assets. And we see that fixed assets went up quite a bit, and that will give us the amount of cash that was used up in acquiring fixed assets, right? So okay, let's see. Basically, it's 1,202, 950 minus 491,000, and that's the gross fixed assets. So the change in gross fixed assets is cash used to acquire fixed assets, right? Then we look at the change in short-term investments. And short-term investment, we go back there and to the balance sheet, asset side, short-term investments actually went down from 48,600 to 20,000. So we must have used that. This is basically if you had treasury bills, etc., in your account, you sold that, and that would generate some cash, right? So that is positive. It generated that much cash. So net cash used by investment activities is 680,350. Right? And then finally, we look at financing activities, and financing is basically raising funds, right? And we got that from changes in notes payable, which is short-term debt, and that had gone up. So we borrowed that much money and raised cash, and then we raised cash by long-term debt, right, which was 676,568. That was the change in long-term debt. We would subtract any dividends that were paid, or and if new stock was used to raise funds, we would add that money. In this case, there's a payment of cash dividends of 11,000. Use that, so subtracted, and now we have net cash provided or used by financial accounting. You can see that here we are using cash dividends. That goes to stockholders, right? But bondholders get interest payments, but we don't put that in here because that was already taken care of in the income statement. So we want to, we want double counted over here. So net cash this time with financing activities, we raised cash. So net cash provided by financing activities was 1.185 million 568. I'm sorry, $1,185,568. Okay, so now let's put those three together. First, we had found that net cash used by operations was 503,936. Next, net cash used in acquiring fixed assets 683,350. That was, basically cash flows from investing activities, right? And then net cash provided for financing activities is positive 185,568, right? So net change in cash is $1,718, and that will explain the difference between the beginning of the year cash flow and the end of the year cash flow, right? So cash balance rather, sorry. Beginning of the year cash balance and end of the year cash balance. That's where we got, so it's negative 1,718. We go back and look at the asset side of the balance sheet, we see that it went down from 9,000 to 7,282, and that is where the cash went, as what we saw in the statement of cash flows, right? So that's how we got to 7,282 from 9,000. All right, so that's what we saw from the statement of cash flows. Net cash flow from operations was negative 503,936 because of negative net income and increases in working capital. And if you're wondering what working capital is basically the accounts difference between accounts receivables and accounts payables and accruals from the current assets and current liabilities side of the balance sheet. Right? The firm spent $711,950 on fixed assets. We saw that by looking at the difference between the gross fixed assets from one year to the next. Firm borrowed heavily and sold some short-term investment to meet its cash requirements, right? That's why short-term investments were down, and both notes payable and long-term loans were up. Even if after all the borrowing, the cash account fell by 1,718. So all the borrowing was quite enough for our investment, the fixed investment. So what's free cash flow? Free cash flow is the amount of cash available from operations, right, for distribution to all investors. So all investors include stockholders and bondholders or debt holders. So it's not the cash available from operations, but cash available from operations minus make the necessary investment, minus the cash used in making the necessary investment to support operations, right? And so what's left after all that is what is available for distribution to stockholders and bondholders. And that's free cash flows. A company's value depends on the amount of free cash flow it generates, and that's what we've been showing in the graphics all along. It's the free cash flow over the future, and the present values, right? All added up is the value of the company. So what do we use free cash flows for? Well, here's the 5 things you can do with free cash flows. You can pay interest on debt, pay back the principal on debt, the amount of the loan itself, pay dividends to stockholders. You can buy back stock, right? Sometimes companies buy back stock to change their debt to equity mix or ratio. Sometimes they buy back stock just to keep in a treasury account because they're giving stock to managers as part of compensation. Or they can use the free cash flows to buy non-operating assets, such as marketable securities, which would be something like treasury bills, or buy stocks of other companies, right? Investment in other companies. How do we calculate free cash flows? Well, we can start from the income statement because that is provided to us by companies' annual statements, or even quarterly statement, but we can start with EBIT multiplied with 1 minus the tax rate to get net operating profit after taxes. Right? Okay. Then we can get net operating profit after taxes and subtract all the net investment in operating capital to get to free cash flows, right? How do we get net investment in operating capital? Well, we start with operating current assets, right? And basically, current assets, we saw current assets were, let's see, we have to go look at the balance sheet again. Current assets included cash, short-term investment, accounts receivables, and inventories, right? So operating current assets will not include short-term investment, right? Accounts receivables as operating current asset, inventory is operating current assets. Then subtract from that operating current liabilities, and what is not an operating current liability from the current liabilities is going to be notes payable, right? So because notes payables basically is a form of debt, short-term debt, it's not coming from operations, whereas accounts payables is because of this what amount we owe our suppliers, right? So start with operating current assets, subtract operating current liabilities, and what you get is net operating working capital. Take that and add to it operating long-term assets, which is basically our fixed assets, right? And then we get total net operating capital. And then take that and subtract net operating capital from last year. So you have to do this process for 2 years. So you get the net operating capital for this year and subtract net operating capital for last year. And then what you get is net investment in operating capital. And that is what gets subtracted from NOPAT. This is called NOPAT, net operating profit after taxes. It's NOPAT, right? And when after doing all that, we end up with free cash flow. And that thing is important because that's how we base a company's value on, right? So basically, here's the NOPAT. You'll start with EBIT, and we have income statements for both years, 2016, 2015. And so if we take income statement for 2015, that's EBIT for 2015 was 17,440, multiplied with 1 minus the tax rate, right? Basically, we're subtracting taxes and 40% and getting the remainder, which is 60%, and we get 10,464. Likewise, NOPAT for 2015 is going to be based on the EBIT of 209,100, and then when you multiply 209,100 with 0.6, which is 1 minus 0.4, you're going to get 125,460. So operating current assets are current assets needed to support operations. So they're not gonna. It doesn't include short-term investments, but it includes the cash balance, the inventory balance, and receivables. Right. It excludes short-term investments. Right. Operating current liabilities are accounts payables and accruals. It excludes notes payables. Whoops, let's go back over there. Right. It excludes note payable because that's basically a financing. It's a source of financing. So net operating working capital for 2016 would be, and just go back to the balance sheet and add up the we add up the cash and the accounts receivables and the inventories from the balance sheet, and then we subtract the operating current liabilities, which is going to be accounts payables and accruals, right? And for 2016, we can calculate the net operating working capital. It comes out to 1,317,842. Net operating working capital for 2015 is 793,800. Right? We take let's see, operating capital is that net operating working capital plus net fixed assets for 2015. The NOWC, net operating working capital, is what we had calculated in the last slide. Add to it the net fixed assets, and we get 939,790, right? So this is net fixed assets. This is the gross fixed assets minus all the accumulated depreciation, right? So operating capital for 2015 is 2,257,632. You can calculate operating capital for 2014 likewise, and we'll get 1,138,600. So the free cash flow for 2015 then is basically NOPAT, calculated before, minus net investment in operating capital, right? And that net investment is difference between 2016 and 2015 net investment in operating capital. So we go back, that 2015 it was 2.257 million, and 2014 was 1,138 million. I think there's supposed to be 2016 and 2015. So there's an error in this slide. Anyways, we look at the we take the difference and subtract it from NOPAT for 2016, and we get that minus 1,108,568 is the free cash flows. Right. So the question is, how do you suppose investors reacted, right, with negative free cash flows for this year? Obviously, not. You would see a decline in stock price. Okay, so uses of free cash flows. Right. Remember, free cash flows are now available to be distributed to investors. So basically, first we made interest payments, right? Interest, and here's after-tax interest payment, because interest payments do bring this shelter, right? So interest payment was 176,000, but you get to subtract that before calculating taxes, right? So 170,000 times 0.6. Is it 100? So let me see one more time. How much was it? I have to refer back to the income statement, but of course it's right there in the book. The income statement for 2016 shows interest expense of 176,000. So if you subtract taxes from it, or multiply it with 1 minus 0.4, which means 100, you're multiplying it with 0.6, take 176,000, multiply it with 0.6, you get 105,600, right? So that's the after-tax interest payment, which we use the free cash flows for. We also had a reduction in, actually not a reduction, it's an increase in debt. We had increases in debt, and so it's a negative amount, right? We basically got some cash flow. So we subtract it. There were dividends payments made. So we add that. There was no new stock that was issued, so there's nothing there. And then there was a sale of short-term investments to raise cash, right? So we're calculating uses of cash right now. So sale of investment actually generated cash, right? Increase in debt actually generated cash. So that's why those are negative numbers. So total uses of free cash flow for this year is negative 1.108 million, right? So we could, we'll talk more about ratio analysis in chapter 3, but here's an ratio that's often mentioned. It's called the operating profitability ratio, and that is net operating profit after taxes divided by the sales of the company. And you can see that for 2016, the operating profitability was 0.18%, but in 2015 it was 2.15%, right? So it fell considerably. So operating profitability fell in that year. The capital requirements ratio is the total operating capital over sales, and for 2016 it was 38.7%. For 2015 it was 19.5%. So the capital requirements went up, basically, which means that we had a worsening of capital utilization during that year. Then return on invested capital, which is ROIC. You must have seen this or heard about this quite a bit, but ROIC is NOPAT over total operating capital, and we've calculated these earlier, but NOPAT for 2016 that was 0.5%, which went down from 11% in 2015. And ROIC fell sharply, and that's due to a decline in operating profitability and increasing in operating capital requirement to generate each dollar in sales. So the question is, the firm's cost of capital is 10%. Did the growth add value? If the cost of capital is 10%. And the question, then you're looking at ROIC and comparing it to the 10% cost of capital. Obviously, it's a lot less than that. So the short answer is no, investors did not get the return they required because 10% is the required return by investors. That's what a weighted average cost of capital denotes. Once again, we got a whole chapter on WACC later, right? So you'll learn more. So, but here's something to note. High rates of growth usually cause negative free cash flows, right? But that's okay only if this ROIC is greater than weighted average cost of capital. But that's not the case over here. Here they give you an example. In 2008, Qualcomm had a high growth, negative FCF, but a high ROIC. So that was okay, and investors will not react negatively to that kind of a situation. But here we have a situation that should worry investors. All right, then there's the concept of economic value added. What weighted average cost of capital is the cost of raising funds. Can you raise funds by borrowing money or selling debt in the form of bonds, in the form of bonds, or you sell stock? So the cost of equity, there's the cost of debt, and given your debt to equity mix, the weighted average cost of capital is some sort of a average, right, of the cost of equity and cost of debt, or weighted average. So it's the cost of raising funds. Whereas economic value added then is our NOPAT. NOPAT is net operating profit after taxes. That's what we had left in for operating profit after paying taxes and expenses, etc., right? And minus total capital times the weighted average cost of capital. So it tells us the cost in dollar terms, right? So WACC is in percent, but when we multiply it to the capital, amount of capital, then we get dollar cost of capital. Subtract that from the dollar amount of net operating profits after taxes, and we get economic value added, right? So economic value added for 2016 is negative 215,299. 2015 it was positive 11,600, right? And we see that impact the stock price. Stock price fell from 850 to 6. There were 100,000 shares outstanding. Earnings per share is simply net income divided by the number of shares outstanding. And if you remember, net income was negative in 2016, so EPS is less, right? So if we look at income statement again, and what we will see is that in 2015, right, net income was 87,960. Let's take 87,960 and divide it by 100,000, and you get 0.87960 or 0.88 if you and then round it up to cents, right? That's earnings per share. You take the net income for 2016, that was a negative 158,000. I'm sorry, negative 95,136 divided by 100,000 number of shares outstanding, and you'll get minus 0.95. So that's earnings per share. Of course, dividends per share is the amount of dividends that were doled out, and the company paid out $22,000 in dividends. Per share basis is 22 cents, 22,000 by 100,000. They doled out $11,000 in dividends in 2016. So 11,000 by 100,000 gives you 11 cents. Now, so economic value added was the value added to the company during that year. Market value added is actually value of the company, value added to the company over the years of its existence, right? So it's market value of the firm minus the book value of the firm, right? Book value of the firm is basically its beginning value. So how do we and book value of the firm is what you see in the balance sheet, right? Book value of the firm is actually the amount of total assets in the balance sheet, or if you look at the other side, total liabilities and equity. Remember, both amounts should match if the balance sheet was prepared correctly. So that's book value of the firm. And how is market value calculated? It's just based on the market value of the share prices. We take the number of shares of stock that are outstanding, multiply it with price per share. We get market value of stock. We'll have add to that the value of debt outstanding. If it's a bank loan, it's just the amount of loan that's outstanding. If it is in the form of bonds that are floating, we'll have to look at the number of bonds outstanding and multiply it with the price of each bond. And of course, book values from the balance sheet. You can look at the total asset side, or you could look at the equity and debt side. Total common equity plus the value of the debt. So if the market value of debt is close to the book value of debt, then the MVA, market value added is is that, market value of equity minus book value of equity. In 2015, the market value of equity was the stock price of $6 times 100,000. and gave you 600,000. In 2016, the book value of equity was 557,630, 632. Once again, this should say a top market value of equity in 2015 is wrong. It should be 2016 here. So it's market value of equity in 2016 is 600,000 and book value is 557,632. We subtract those and we get 42,368 is the market value added. In 2015, actually, price per share was $8.50. So market value was 850,000. All right, book value of equity was 663,000, and market value added is 186,232. Right. So, all right. Basically, what we did was we forgot about debt, right? Why? Because market value of debt is close to the book value of debt. Then we don't have to worry about it. We can just look at the changes in market value of equity, and that's what happened. There was no difference between the market value, book value of debt for this company, for Computran. So we can just look at the differences in the value of equity, market versus book value of equity, and that's the market value added. Right. All right, now let's look at how taxes are calculated. Now this has changed, right? So the next edition of your book is going to have revised tax schedules, and you know that the rates have changed. The rates have gone down in most brackets, and this taxable income is calculated based on your total income minus, you know, the standard deduction, personal exemption, etc. for people, right? For companies, it's basically all the, you know, revenues minus all the costs, minus depreciation, etc., minus interest payments. They have a lot of things that they can write off, and then whatever is left gets taxed this way, right? So let's keep with this schedule. The only thing that's going to be different is that the numbers in each bracket will have changed, and the rates would have changed, and the highest corporate income tax rates now is 21%, right? But it's going to be 50,000. The first, we'll just look at what we are seeing here, right? The first 50,000 is being taxed at 15%. First 50,000 of taxable income. Then the next 25,000 gets taxed at 25%. So this is a marginal tax bracket, right? The next 25,000 gets charged at 34%. And then after 100,000, the next 235,000 will get charged 39% taxes, right? So you can actually basically look at the base. So suppose you're making $60,000. Suppose you're making $60,000. What that means is that you are going to get to pay this 15% rate on the first $50,000. Well, 15% of $50,000 is $7,500. So you'll pay $7,000 plus 25% on the remaining $10,000. So you can basically start with this tax on base. You start with $7,500, take and say, well, how much more than 50,000 am I making? 60,000 would mean 10,000 more. So you calculate 25% of 10,000, which is 2,500, right? Add to this tax and base of 7,500, and you get to a total of 10,000. So on a taxable income of 60,000, you're going to be paying 10,000 taxes, right? So you're on average then 10,000 out of 60,000, right, is 10,000 divided by 60,000 is 0.1667. So you're going to be paying 16.67% taxes on your $60,000. So it's not 15, it's not 25, right? But that's the purpose of this progressive schedule, is that if you make more and more and more, if profits are higher, then on average the taxes become higher. So you can see that this looks a little weird. There's a range where you're paying 39% on marginal income, and then it drops down to 34%, and it might look weird, but what it's doing is that by the time you are paying 335,000, your average tax, not just the marginal, but your average tax also gets up to 34, right? And then after that, you're going to keep paying 34% up to 10 million, and above 10 million it goes up to 35. And once again, you can see that there's a marginal increase, and that is to bring your overall tax rate to 35%. And so if you make over 15 million, then you are paying 35% in taxes. I'm sorry, that's not right. If you're making over 18.3 million, then you're paying 35% in taxes, right? On average. So that's how taxes are calculated, right? So we basically have progressive rate up until 18.3 million of taxable income. So up until 18.3 million, the tax rate remains. It slowly climbs up from 15% to 35%, right? And then after that, the average becomes 35%. So above the 18.3 million, the marginal rate and the average rate are 35%. Of course, remember, taxes are not being paid on all the income, because a corporation can deduct interest expenses, right? But not dividend payments to stockholders. Interest expenses to bondholders, but not dividend. It can carry back losses for 2 years, or carry forward losses for 20 years. So in our case, Computron had made a loss, had made a big loss in 2015, but I'm sorry, 2016, but it was able to recover all of that because it had paid positive taxes in 2015 and 2014, presumably. So it could say that he got a tax refund that year. But if it hadn't made profits in the past 2 years, it can actually deduct that over the next 20 years of profits. A company can exclude 70% of dividend income if it owns less than 20% of a company's stock, right? So if a company, if Computran had purchased shares of another company and received dividends on those shares, then 70% of that dividend income can be subtracted, right? As long as Computron is not a big owner, right? Less than 20% of that company's stock. So assume a corporation has $100,000 of taxable incomes from operations, $5,000 of interest income, $10,000 of dividend income. Then what is its tax liability, right? Let's see. So first, you can get operating income, interest income, add that, right? This is interest income. This is not interest paid out, but this is interest that the company earned from its, marketable securities. And then there was 10,000 in dividends, but 70% of that is excluded. So only 30% of 10,000 is taxable. So 30% of 10,000 is 3,000, and the company's taxable income is now 108,000, right? Now, so how much will the taxes be? Well, yeah, we're looking at it's 108,000, right? So if we go back and look at the tax schedule, it says for the first 50,000, it's going to be 15%. The next 25,000, 25%, right? So the first 15,000, 50% of 15,000 is 7,500. 25% of 25,000, right? How much is that? It's 6,250. So 7,500 plus 6,250 gives us 13,750. Then 34% of the next 25,000, right? And 34% of 25,000 is 8,500. So add 8,500 to the 13,750 and we'll get 22,250, right? And the company's taxable income was 108,000. So now we're left with $8,000. So the next 8,000 will be calculated. Now for the next 8,000, the rate is 39%, right? So 8,000 times 0.39 gives us 3120. So we'll add 3120 to the 22,250 and we get 25,370. And that's the tax liability on $108,000 of taxable income, right? So it's 25,370, right? So at this point, the marginal tax, the tax on the last dollar company earned, actually last $8,000 that the company earned, was 39%, right? But what is the percent tax that the company pays on its entire income of 108,000? That's 25,370 divided by 108,000 gives us 0.2349, about 23.5%, right? 23.5% is that's the average tax rate. So the marginal tax rate is 39%, but the average tax that the company paid as the rate is 23.49%, right? Now, individuals also face progressive tax rates, right? These rates have gone down also, but not as much as the corporate tax rates, and our new tax laws written in such a fashion that the individual tax cuts will actually expire in 10 years. But the corporate tax cuts are permanent. Anyways, once again, we are looking at these old rates right here. They are progressive and they start from 10%, go up to 39%, right? So you know what progressive taxation means. It means that if you're making more money, you're paying more in taxes, not just in dollars, but also in percentage, until you get to a certain point where, which is 35% in corporations. The rate on long-term capital gains is 15%, right? And basically that comes from maybe owning some stock for over a year and selling it. Then the gain you have is called long-term gains, and you'll be paying 15%. But the capital gains are only taxed if you sell the asset. So if you own stock and its value has grown, but you haven't sold it, well, then you're not liable to any taxes. Only when you sell it and you made a profit, then you have to pay taxes on that profit, which is at 15%. Dividends are taxed at the same rate as capital gains, which is 15%. And interest on municipal bonds these are state and local government bonds, is not subject to federal taxation, and the federal government allows this courtesy so that people, so that school boards, local governments, they can issue bonds, and people will buy them because they don't have to pay taxes on the interest they get from those bonds. State and local government bonds, or also referred to as munis, they are generally exempt from federal taxes. Okay, so when we're making comparisons between, say, a corporate bond and a muni, here, if we are subject to a 25% marginal tax rate, right, how do we make comparisons? Well, we actually look at the after-tax rate from the corporate bond and compare it to the munis, right? So ExxonMobil, right, let's say pays 10%. We have $5,000 invested in ExxonMobil, and we get 10%. Well, we wouldn't quite be able to get 10% of 5,500, right? We'll get 500 in interest, but we then have to pay a quarter of that, 25% of that, in taxes. So 25% of 500 is 125. So 500 minus 125 gives us 375. So even though ExxonMobil is paying 10% interest, what we get is $375. Whereas if we have California municipal bonds that pay 7% on the same $5,000 investment, right, 7% is $350. And so we would calculate, there's no taxes to be paid. So it's pretty close, right? It's pretty close. And so we make this comparison. We look at the after-tax cash flows from interest payments from the two and then make a decision. In this case, the ExxonMobil bond still comes out ahead because we get 375 in interest every year, not just 350, right? So then the question is, what should be my marginal tax rate before I'm indifferent between the two, right? And so we take that 7%, which is the municipal bond yield, and look at what T here would actually give me an equivalence where 7 here equals 10 times 1 minus T, which means again say 7. So let's see, multiply this out, it's 10 minus 10T, right? 7 equals 10 minus 10T, or 10T equals 10 minus 7, which is 3. So T equals 3 divided by 7, or 30%. So we got a couple steps of algebra here to get the value, the missing T, which is 30%. So if my marginal tax rate is 30%, then I will be indifferent between the two. If it's higher than 30%, actually, I will prefer that municipal bond. So munis are actually preferred by the rich people or high income people who have higher marginal tax rates. So T is greater than 30% by the munis. It's less than 30% by the corporate. So only high income and high tax bracket individuals should buy municipal bonds. All right, so this brings us to the end of topics to be discussed from Chapter 2. I'll have a similar one, Chapter 3, using the mini case, and then we get away from mini cases, and we'll have the other lectures will be more fun. Accounting is kind of hard to make more fun. Anyways, we'll see you with the next lecture soon.